All right, ladies and gents, welcome back to the Smash Property Podcast. I'm Nick V. This is Akira. Today's episode is all about how to use debt to build wealth, and we're going to share some stories of our own experiences building our own portfolio, some stories of some clients that we've worked with, but importantly, what you can do as a listener out there to take advantage of the system that we have to build wealth in the background, which is ultimately why we are property investors. So this episode is packed with a lot of insights from my 20-year now career in property and finance. Akira's going to punch out some questions my way. But before we get into that, Akira, welcome back.
Thank you.
How you doing?
I'm doing good. I've been missing these podcasts. I feel like I've been in the background a little bit.
Yeah. I'm sure the listeners have too. They're just the last 2 weeks were just me ranting about stuff.
I enjoyed them. I listened to them in my own time, and
good to have you back, and pumped for today's episode.
Yes,
talking about how to use debt to build wealth. I'm keen to get into it.
Yeah, so I was going to say we'll keep this as a Q&A kind of style podcast. I think you're very articulate and concise with downloading.
Phones off, silent, we're recording.
No, I keep it. You could have kept it in.
Yeah, no, we'll keep that in.
Oh, okay. But yeah, no.
You can't be doing work while you're freaking doing a potty. Turn that off. Put that out there. What are you doing?
I'm multitasking. I'm
a
woman.
Right. I can't do that.
But all fairness, we're going to keep this nice and concise. I think the topic of debt is a very valuable topic. Everybody has preconceived ideas of whether it's good, whether it's bad. Different generations, different kind of aspects, different avenues of life have different, I guess, relationships with debt as well.
Different cultures have different ideas about it. Yeah, for sure.
Exactly. But we're speaking, I guess, from a strictly property investing side of it and how you use it as your friend to grow wealth. So I think let's start from the basics.
Okay.
I guess maybe you can explain to us exactly what the difference is between good debt versus bad debt.
It is a good question. And there's a lot of, information out there about good debt, bad debt. Let me just make it really simple, really clear. Good debt is tied to an income-producing asset or an appreciating asset. Ideally, it's an appreciating and income-producing asset. Bad debt is not tied to those things. Bad debt is a credit card, personal loan. I would even say a home loan, as in your owner-occupied home loan, is a bad debt because you're not earning any income. You have to you're the one going to work. You're the one paying the mortgage and you're on the line for it. The good debt is you have a tenant. They're paying most of, if not all of the mortgage. The property's also covering all of its own expenses, and it is also appreciating and growing in value. That is my definition of good debt. Bad debt, there are technical, versions of what that actually is, but it's basically one makes you money and one doesn't.
Easy. I think that's pretty simple, concise. Is there anything outside of property that you would say that is good debt?
You could argue that, if you got a loan to start a business and the business is going well, the business is producing an income, the business is growing in value, then you could probably argue that is a good debt. There's certain, debt that you can tie to other assets outside of property, and sure, you can argue that they're
maybe
good
it's like a car
well.
That's collectible or something like that.
Well, that's putting it as a stretch. I love cars, but I would never say that a car is a good investment unless you're talking, those high-end McLaren F1, Ferrari F40 type things. But I would never say a car is a good debt to have at all. No.
Okay, so with that, why is debt such an essential tool to building wealth?
Yeah, another good question. There's good, strong fundamentals behind this. So why would we want to use debt to build wealth? Why not just, save, use our own cash to go and buy these properties? At best, we buy property cash. At worst, we put down 20% cash deposits every time we go to buy a property. The fundamental reason why we would want to use debt instead of our own money comes down to how quickly we can actually save our cash to go and buy the property. So for example, and I'm just talking about averages out there. For the average person, right, earning, between 80 and maybe 150 grand, or, even if you're in a couple of $100,000 a year, your ability to save and outsave the market is next to impossible. And I don't care how savvy you are, how tight you are with your budget, the market moves and it moves quick. So every single property that I have personally, because I look at this every single month, almost every single one of them goes up in value by about 10 grand a month. So in order for you to outsave that, you've got to save 10 grand or more a month. Now for the average person, that's going to be a tough ask to do. You got to be on some seriously good coin to be able to do that. So the reason I'm saying that is if we're trying and waiting to save, other than our first deposit, you're actually putting yourself backwards, because by the time you save your 100 grand, the property market's gone up by probably a couple of $100,000. So you're constantly going to be sort of chasing your tail in that regard. So that is why the first one is almost always going to be cash, unless you have, an existing owner-occupier property, or maybe your parents are helping you or whatever. But most people have to save for their first deposit. That's cash. Everything else after that, with the reason we use equity is because we can leverage it now, so long as we can service the debt. We can buy another asset now and have those assets grow in value now, rather than trying to wait for another year or two to save more, because the property prices are going to go up exponentially more than what we can actually save. So that's the reason why we would want to use debt, particularly when we start to scale a portfolio and use that equity as deposits to go and buy more properties with. It's just because we just can't save quick enough.
So it sounds like it's time being the biggest thing that it buys you using debt.
It is, and that's a great point, because it's, people say this all the time, and it's just about the time in the market. So the number one goal is to get as many assets as you can as quickly as you can, because that way then your wealth is growing exponentially from now, rather than trying to wait 1, 5, 10 years from now.
Yeah, exactly.
Yeah,
that's interesting. And then with that, you did mention something about buying a property cash, or with that answer. Would you have thoughts on someone buying a property cash versus buying it using leverage, using debt, and what their situation or circumstance could look like in 10 years? Like, what would be the better option for an everyday person buying an investment property?
The better option is, instead of going, like, let's use the 500K property as an example, right? Of which there are loads of properties out there for 500K. Maybe more on that another time. But let's say you had $500,000 in cash, you got it from an inheritance, or maybe you were really good saving, whatever. You go and buy one property with that 500K, cool, fine. You've now got a property that's unencumbered. You're probably getting, $550, $600 a week in rent. Take off, $150 of expenses. You're left there with, $500, maybe $450, depending on what the rent looks like, right? No, okay, cool. You got a $400, $500 a week. Versus you going to buy that property with leverage and then putting a 20% deposit down, so $100,000 instead of the $500,000. You've still got the same rent coming in. Yes, you've got a mortgage, which is going to be mostly taken care of by the rent coming in. However, you've got $400,000 in cash. You can then go and buy 4 other properties with, so long as you can service the debt. So instead of having one property that's growing in value, you've now got 4 properties growing in value. And over time, the debt, let's say you didn't pay down any debt. The debt stays the same. The property keeps on growing in value. And then the difference between the property value and the debt is yours. That's your wealth. So it makes sense to have as many of those things as you can growing in value, so that when it comes time for you to, retire, you've got these assets. Yes, there's debt. Absolutely, there's debt. Let's say you don't pay down a cent of debt. There'll be tons of it, but there'll be also tons of wealth on top of that. So long as you've done it the right way and you've bought in the right markets. So that's the real reason why we want to use debt and not our own cash.
Yeah, 100%. I keep thinking about time and
so important.
Exactly, because there's these, historical videos that will pop up on documentaries and things like that. People from 60s talking about properties that they bought for 50K.
Not even. No, you're buying blocks of land for a couple $1,000. Like,
I know.
I bet you if you could go back in time and tell them, hey, that property is now going to be worth, 1.2 million in 2025, you would buy as many as you possibly can.
100%. No, it's all relative. I get that. But at the same time, too, I think with inflation, it just is so interesting how just a couple of years, I mean, look at Brisbane in the last 5 years, had 3s in front of them. They now have almost all of them a 6 in front of them. Some in a 5, but majority of them are in 6s and upwards. So it's an interesting one. Imagine having debt of 300K or even less than. Yeah. And now having a property value double that.
Yeah, exactly.
That's
and
incredible.
we'll get into a bit of that in a little bit later in the poddy.
Yeah, definitely.
The inflation and debt relationship.
Okay, so with that in mind, what strategies would you recommend or advise for someone who wants to safely leverage debt in their property portfolio?
Before I answer anything, this is not financial advice. I'm not a broker and I'm not qualified to give financial advice. However, I can give my own opinion. So what strategies, I guess the question is more so, okay, if I want to do this and, I understand that I need to leverage debt, how can I do this safely and how can I do this so I'm not kind of over leveraged? How can I do this so I'm not sort of backing myself into a corner? And I think it's a great question. So the reality is, like I said, you want to make sure that your debt firstly is tied to an asset. Now, the fundamental key here is buying a property, if you're doing this yourself, buying a property in a market that you know with relative certainty that it is going to increase in value over time. Now, it might not double it doesn't need to double in price in a couple of years or 5 years, but just consistently over time, it needs to be increasing in value. That is probably the fundamental key. Because the last thing you want is to buy a property in an area where there's just no growth. The growth is where the wealth is created. So you need to understand and know that the market is going to grow in value. That's probably the first thing about using debt and using it safely. A couple other things is making sure that you have an understanding of what that debt is going to cost you. So a lot of people tend to forget that when you buy a property, and let's talk about a freestanding house here, you've obviously got a mortgage and you're going to have to pay it back, right? You put a tenant in there to pay back most of, if not all of the mortgage. However, there are also other expenses on top of that we need to factor in. So understanding, and we talk about this a lot, the numbers behind the investment, because after all, we are property investors, not property collectors. We want to make money out of it. So you need to understand the numbers behind the deal before you actually buy the deal. So number one, make sure it is an area that grows in value. Number two, make sure you understand the numbers behind the deal so that you can make an informed decision before you sign the contract to go, yes, I understand that these are the numbers and I understand that this is an area that's going to grow in value and I'm comfortable with that. You don't want any surprises after you've bought the property. You want to know that before you sign any documents. So that's probably, I guess, a practical way of how the listeners can make sure that they're protecting themselves and not over leveraging and putting themselves into a bad corner. And I think probably just before I wrap that up is you can get into too much debt, right? You can get into a situation where some banks and some non-bank lenders will just love to keep lending you money. All right. So it's again really important to make sure that you're understanding the numbers and your cash flow position at the end of the month or however often you get paid to know that you can manage that debt over the long term. Because the last thing you want to do is get yourself over leveraged. You're going to have all this stress and all this debt. So make sure that you know all of those things before you move forward with a purchase.
That's very fair to say. I think the last thing you want to do is be a property investor, get yourself a couple of properties and not be able to hold them. That's
Correct,
the worst part of it.
Yeah.
Actually, on that note, from being a property investor and speaking to different people as a buyer's agent, what have you seen out there being some of the most common mistakes that people have made with using debt?
There's a couple of things that come to mind. I think people that I don't know where this comes from, whether it's FOMO or I've even had people that have blatantly just said, hey, look, we had a good run through COVID. I thought I knew what I was doing, and now I'm stuck in this position where I'm hemorrhaging 10 grand a month out of pocket after expenses. And so I think some of the common mistakes that I see is people just buying any old property for the sake of it. Just thinking with that mindset that all property's growing value. If I buy this, then this is going to set me up for retirement and that sort of thing. So probably first mistake is just buying any old property and wishing and hoping that it grows in value. Probably second biggest mistake I see is just people buying in the same city that they live in for no other reason other than because they want to be able to go and see the property. And it's like, that's just you're not an investor then. You're like, what, it doesn't make any sense in my head. You got to buy in the right market at the right time. So I've had a few people that lived in Sydney. They wanted to buy investment properties in Sydney. They got way over leveraged with these properties in newer areas. The rents are nowhere near covering at least half of the mortgage. So they are just completely out of pocket. Properties haven't grown that much either, particularly in Sydney and some of the areas where I've seen people buy. And so they're kind of stuck. If they sell, they don't really make any money. They probably might lose a little bit because after the CGT and closing costs, that sort of thing. So just buying in an area where you live because you live there, probably mistake number 2. Mistake number 3 is getting sucked into deals and I guess just marketing stuff where you get promised, a specific amount of cash flow, or there's rental guarantees, or there's all these sorts of guarantees that people give you to give you the confidence to go and buy these properties. And every single investor that I have spoke to that have dealt with these companies have come back with a horror story. I'm not saying that to scare people or anything like that, but you've got to do your research on these companies before you commit, and read the reviews. Because I've seen countless amount of people and they're stuck because their deposit's there and they're like,
it's heartbreaking.
Property's not going to be built for another 4 years. And it's like, okay, well, what about my money? And it's like, you can't do anything about it now. You're committed. So
and you get into this with the intent of making money and growing and going somewhere with terrible. It's pretty awful. Actually, thinking about what you've just said, another thing came to mind just working with one of our lovely clients who's connected to our broker just recently. Cross-collateralization is also a big factor with structuring debt as well. Maybe you can talk to that and how in some circumstances it isn't as beneficial, especially when you want to grow a portfolio.
Yeah, look, there are pros and cons to cross-collateralization as it relates to property investing. I've done it once. I would never do it again because it is quite restrictive in the sense of you being able to move forward from that current position. So some of the pros might be that the lending could be a little bit easier and streamlined up front. You might be able to get a better rate with the particular lender that you're in. And in some circumstances, that is really nice and really easy. It's like, hey, they're able to lend you a little bit more. They give you a bit of a better rate, and they make it easy. The downside of that is when it comes time for you to refinance, your whole those two properties that are cross-collateralized are essentially linked together. So not a huge deal. But if you want to, if you run into some financial difficulties, for example, and you can't pay back one of the mortgages on the investment property, your owner-occupied property is then on the chopping block as well. So as I said, there are pros and cons, and it depends on the situation that you're particularly in. I would never do it again because when it comes time to refinancing, I want to pull equity out of my investment property, have it as its own sort of entity over here, and then use that to go and buy, keeping my owner occupied out of it. But yeah, again, that doesn't mean that it's all terrible to cross-collateralize your properties, but I'd be speaking with a broker before cross-collateralizing anything, and understanding, the real reason that you would want to do that in the first place, because it really benefits the lender, not particularly you as the investor.
100%. So I think most importantly with this podcast topic, I think I specifically really wanted to do it because, my relationship with debt has obviously advanced and changed over the years, over being a property investor. When I was new to it, it scared the shit out of me because, I saw that negative amount of money owing. Yeah. And I didn't quite realize how much my properties would grow and how quickly and effectively they would grow. Even though I did my projections, it was stressful. So I think, also speaking with a lot of people wanting to get into property investing as well, you'll have one, if you're speaking with a couple, sometimes you'll have one party super keen to do it and one party potentially quite risk averse and stressed out about it. So I think it is one of those things with educating and understanding how it works. It is such a critical aspect on your journey for property investing. I think most importantly, when I spoke to you about it and when we were growing a bit more in the portfolio, understanding how important it is to leverage the bank's money and, you know, make the most out of it if it's there to be used. What is your take on leverage and how it works with debt and building a portfolio as well with that in mind? Like, what is your personal perspective and the value that you can give to the listeners in how it all works in a nutshell and a bit of a summary?
Yeah, so I think a lot of people, you know, yourself, as you just mentioned, myself to a degree, although like I said, I've been in banking and finance and property for, you know, near 20 years now. So probably before that point, I didn't really understand debt as I do now. But if you're a listener out there and you're petrified, like, oh, I don't want to, interest rates can go up at any time, and I don't want to be burdened with, you know, a $500,000 debt or $1 million debt or whatever it is. Just understand this, and the debt that you have today is going to be made irrelevant with inflation over time. Today's debt is paid with tomorrow's inflated dollar. So this is the secret that literally the wealthy elite use to their advantage, and we've all literally just seen this before our very eyes over the last couple of years. Right, we've seen this massive amounts of inflation. What's happened in that time? Property prices have increased in value. It's not the property that's gone in value. It's the currency that's actually lost its value. So you need more of that currency to go and buy the same property, right? So if you're sitting out there and you're worried about debt, let's go back to the beginning of the podcast. And I said, there is good debt and there is bad debt. I would be petrified of having a $50,000 credit card. I totally get it. That is a bad debt. You do not want it. But I would love to get my hands on $500 million worth of debt that's tied to income producing assets. Why? Because that debt is going to be eroded with inflation over time, right? The debt that I have today, I'm going to be paying it back in 5 years' time with an inflated currency, right? So instead of paying it back with $1 today, it's probably going to be the currency I'm earning in 5-10 years' time might be $10. And I can wipe out that debt like that, right? The fundamental key, just bring it back to property investing. And this is why you want to get your hands on as many of these properties as you can in a shorter time period as you can, so you can actually ride that inflation wave to a point, say in 5-10 years' time, you could probably sell down one property and not pay a cent of debt back that whole time and wipe out every single bit of debt that you have. You will then unlock that whole property portfolio being unencumbered, and that cash flow would then be yours. This is what not many buyer's agents would tell you. This is definitely not what you're going to hear on the news. This is definitely not what they're going to teach you in school. This is the number one reason why the wealthy 1% are the wealthy 1%, is because they leverage debt. Why does Elon Musk, why does Bill Gates, why does Apple, they have all of this cash, they have billions of dollars worth of cash, but they still go out and take out debt. Right? It's for that very reason, is because they can erode that debt away over time through inflation. And we could go down a whole huge rabbit hole here of why inflation exists and all this sort of thing, and we will leave it for another party. But that is, like, if there's one thing you take away from this, it's knowing that you pay down today's debt with tomorrow's inflated dollar. And with that, it just makes so much sense to really just, as quickly as you possibly can, get your hands on as much good debt tied to a house, basically, as quickly as you possibly can. You don't want to go out and buy any old house. You want to make sure it's in an area that grows in value. You want to make sure the cash flow is strong enough that you can hold it. You're not burning a hole in your pocket, but you do that as quickly as you possibly can. I'm telling you, your whole life will change, because you'll have so much asset and so much wealth behind you, and it can happen very quickly.
Definitely. I love that. That was my light bulb moment when I realized that fact on how it all works, and that there's a layer to this that is not seen, is not taught to you. And I think once you comprehend it, I had to map it out, draw it out to really understand that gap for inflation and understanding today's debt, tomorrow's dollar. But once I saw it, I was like, give me all the debt and let's just start buying. But I think also importantly, it's also realizing as well, because for me, I think I'm very risk averse. I think I want to be protected in the sense of being able to not put myself in a position that I don't need to be in, especially with debt. But the great thing about the whole thing with property, worst case, say, something were to happen to you in the future or, for whatever reason, you're in a circumstance where you don't have an income. What's the worst that is going to happen? You'll sell off the property. That's it.
Yeah.
And I think also once I realized that, it was a lot more, I guess, reassuring to me that this was a good decision and that as long as you're strategic, that being the key factor with purchasing a good property that works, it can be to your advantage and create so many opportunities.
Yeah, and I think, you're totally right. Obviously, yes, property's not very liquid. It takes some time to sell a property, etc. But, you can definitely make that happen if you run into some personal hardship. My sort of fear, and we've spoken about this quite a lot, is the only thing that really scares me about what can go wrong with property is a couple of things. A currency reset. So if for whatever the dollar collapses and there's a new currency that comes in, how is that going to relate to property? I think just looking at other countries where they've had this hyperinflation come through, currency reset just means they take zeros off the end. Instead of a property being $1 billion, it's now back to 100,000. So that scares me a little bit because there's a bit of unknowns with that. A big thing propping up the Australian market at the moment is the net overseas migration. So if that were to slow down or stop, the market will slow down. There's no doubt about it. We just don't have the population here to support that current, that growth. So that is something to consider and keep an eye out on. How migration plays a factor. But at the end of the day, the one reason that gives me total comfort is that we're all going to need somewhere to live. Like that doesn't go away regardless of whatever happens with the economy or anything like that, right? So. There's always going to be a need for housing. There's not always a need to have an Apple iPhone or an Android phone, whatever. Like, like investing in stocks in companies that may or may not exist and may or may not have a demand for a product in time. There's a lot of risk in that I see over time.
It's a tangible asset.
It's a real thing, yeah, 100%. And so there's obviously a lot to consider. And we're not sitting here saying that it's risk free and get your hands on as much debt as possible and be irresponsible with. And that's not what we're saying. There needs to be a strategy behind it. You need to have your focus and eye on a bigger goal, but at the end of the day, don't overthink it, and don't be petrified and putting yourself on the sidelines. So much so that you don't actually make any decision at all, because the people that are going to get hit the hardest is unfortunately the people that don't have assets behind them, whether it's a business, whether it's property, whether it's stocks. If you wanted to get out of that 9-to-5 rat race like a lot of people are, you're going to have to make some choices, and they're going to have to be some hard choices and maybe some sacrifice. But at the end of the day, like I've said on other podcasts, in 5 years, your life can change dramatically so long as you're committed to it over time.
Agree.
Yeah.
Agree. I think that was a great summary of how it works. Hopefully we explained, or you explained, the detail of how it's all connected. There's layers to it, importantly, and how it is all synchronized together to create a situation, as long as you use it to your advantage and see where you can, I guess, make the most out of it. Because I think at the end of the day, we're living in a time where there's many people who hate property investors. There's many people who are totally against using debt. But like most things, there's good and bad with everything. You just got to know your situation and your circumstance and see if it works for you. Because if you can get out of a situation, why wouldn't you?
100%. I totally agree. There's lots of property investor hate out there. There's lots of people just hating on people being successful, particularly in this country. It is what it is. With you don't get the good without the bad.
Yeah.
The tall poppy syndrome is real. It's alive and well, unfortunately. And that just comes with it's an unfortunate side effect of being successful in this country.
I think so, but I think it's also having that empathy for people who might not understand it, who have been, I guess, maybe taught the wrong thing or not had information given to them, or maybe even had it withheld from them, where they actually are the ones who are living in a cycle where they can't actually get out of because they've been potentially brainwashed or not really understood the detail.
Now we're getting into some rabbit hole territory.
Okay, yeah. Let's wrap it up.
There's a big brainwash of things out there. Anyhow,
Nick.
It's my potty. I can do what I want. You don't like it, tune out. Unsubscribe.
I love it.
So there was tons of value, and it might take some time to sink in. So you let us know in the comments if you've got questions around things that we've just mentioned. If you agree, you disagree, let us know. Love to hear the feedback. But I think we'll wrap it up there.
Shout out to our broker as well if you need help with finding debt.
Oh yeah. I was like, what? No, definitely. If you need help, speaking to someone who is a qualified professional other than myself as it relates to debt and finance and mortgages, we do have a great team behind us as well. So please reach out. Happy to put you in contact with the right people, broker, accountant, that sort of thing. And obviously, if you need help buying the right property in the right market at the right time, this is what Akira and I specialize in. We do this, week in, week out, month in, month out. The $500,000 properties are real, guys. We put out videos and people don't seem to think it is real. You can absolutely do it. We've got countless, stories of investors that we've helped get into the market at that price. Know this, the market is moving every single month. So if you come back to us, in 6 months' time, those $500,000 properties are probably no longer here. But as of right now, they are here and they are alive and well. Tons of people are buying them and making money out of it and using the debt to their advantage to build wealth. If you want to make that happen, reach out to us, 0452046274, smashpropertyinvesting.com.au. We're on all the socials. Make sure you follow us and enjoy the journey. But that's all we have time for today. Thanks so much to Akira for preparing those questions. Thanks to me for answering them. No, you should say that.
Thank you for answering them.
But we'll wrap it up. Thank you so much. Until next week, we'll catch you soon. Bye.
Thank you.